So we have 30 minutes here. I want to keep the discussion as meaty as possible. My name is Catrina. I run Portal Ventures. We do one thing, that's to lead pre-seed checks into lead first checks into pre-seed companies. And Plume is one of a very lucky investor of Plume. And I will fold the introduction into the first question, which is, as the institution enter into the RWA in the crypto world, what should be the mental model for them to evaluate against different RWA providers? And and please introduce yourself along the question.
Hey guys, my name is Teddy. I'm the co-founder of Plume. What we're building at Plume is, on a high level, a open blockchain that's focused on real world assets with DeFi at the core. I say there's three things that we're focused on, which kind of answers your question, Catrina. One, we're very focused on infrastructure. Two, distribution, and three, composability. On the infrastructure side, we've built all these different types of products to bring anything on chain, whether it's physical assets, esoteric data sets. But the biggest question we usually get is, when these assets are on chain, how do you actually find them real users and real demand? And this is an answer or actually a problem that we're solving for a lot of our institutional partners as well, because I think traditionally in RWAs, people just tokenize a bunch of assets and they hope that buyers come. But that's not really what we've seen work in the space. So what we do differently is work with different distribution partners, whether they're different exchanges, custodians, different communities. And we find these, assets real demand. And then on the third pillar that we're focused on the DeFi side, we actually blend RWAs and DeFi in a very unique sense to make it feel more like crypto and less like TradFi products. And I think that way we're actually able to kind of bring in real adoption to real world assets. Today we're the largest chain by RWA wallet holders. We have around 200,000 wallet holders. I think the space itself only has around 390,000. So we're at a little bit more than half the space. We have around like 500 mil of TVL. So a lot of these products that we're creating are actually built for more on-chain users and institutions that are looking to kind of come in, collateralize their assets and borrow against it and just use them within DeFi. So I think, that's kind of how we've created an ecosystem and a moat that really appeals to both retail and institutional investors today.
Hey everyone, Omar, Azhar, VP of Business Development at ZKsync. At ZKsync, we are building large-scale encryptable infrastructure for financial institutions with ZKsync Providiums, allowing anyone to build their own private layer 2s with interoperability. And so our client base right now, for the most part, would be traditional banking institutions, central banks, nation states that are looking to deploy and move on chain, whether it's for tokenized deposits, very different other types of RWAs. I think, can you repeat the first question again a little bit? It's been a while.
Yeah, it's been a while. What's been the mental model for an institution to evaluate against different providers of RWA infra?
Yeah, okay. So on this one, it would you're essentially making a two-sided marketplace that's relatively brand new in the crypto world that doesn't necessarily exist. I think a key determination that we tend to look at, and also both the asset issuers that we work with and the buy side that we work with, is really around the sophistication of the assets and the types of people or institutions that are actually buying these assets. We're not necessarily going B2C. We're not really going after retail. We are mostly going after more the traditional institutions that are moving on chain. They're looking for portfolio diversification, looking for access to institutional assets that they don't have access to in either their domicile, their region, or the asset issuers that are looking to further expand from their current asset base as well.
Hey everyone, I'm Matt. I'm head of DeFi at Ondo Finance. We focus on tokenizing, I guess, the most liquid assets. So we started with treasury bills, moved into equities, which we launched a couple weeks ago. We're now by far the largest provider of tokenized equities on chain. And generally, that sort of mental model is how I approach everything in the RWA space, which is liquidity comes first, right? So for a lot of institutions out there, I think to Teddy's point, like to tokenize stuff and hope that the demand shows up, right? And that's like buy side liquidity, right? But you also, if you have a product that people want to buy, you need to have sell side liquidity. And liquidity itself is extremely expensive within the crypto space because all of the assets have to be fully funded to, from the very start. As opposed to in TradFi, you can sort of get a little bit of credit with like T+2 settlement and that sort of thing. So a lot of the institutions we talk to wind up getting excited about our products because they have better liquidity profiles. And even just like at the high level design stage, I would say that the most exciting partnerships that we find are people who are looking to make their assets better on chain, and usually that involves some kind of liquidity overnight when markets are closed, or over the weekend when they can't get credit. And so for your typical institution out there, I think you kind of want to look at like not only like where do I slot myself into the aggregate, DeFi RWA landscape, but also what are the different sources of liquidity out there, and how do I position myself at the center of them as best as possible?
Yeah, I think my next question can dovetail nicely into the topic of liquidity and the type of assets and product all of you offer. What's been the appetite from these institutions as they, okay, like, is it T-bill, is it fungible, is it infungible assets? Like, how would you rank the asset class in terms of difficulty and time horizon to bring on chain? Maybe I'll start with you, since we're just literally talking about that.
Yeah, I mean, I could talk for days, but the issue with the illiquid assets is that primarily the ones that we see coming on chain, look, there's many issues, but one of the biggest issues is that there's a huge selection bias, right? We actually were on a panel all together earlier this year in New York, and I get off the stage and some guy comes up to me, sorry guy, if you're in the crowd, I don't think he's in the crowd, and he's like, hey, we're tokenizing precious metals mining companies in Central America. And I'm like, oh my God, the amount of just like, asymmetric information that goes into that asset, I could never in good faith recommend that we like even touch something like that, because users can get rugged, we can get rugged. We don't know what jurisdiction these things are happening in, and like mining is a risky industry in and of itself. And I think you wind up, especially in the illiquid side of RWAs, with a lot of just like kind of not so great feeling projects, right? Real estate that's like maybe worth what it says it's worth on chain, but it's actually not. And it's just like a TVL boost. And so I think, primarily where I see the demand is really for assets that like there is proven demand for. And I think you can see that in just the liquidity profile of the assets off chain. So treasury bills, most liquid market of any asset ever in human history, right? There's bound to be some demand for that on chain. Similar deal with like tokenized, US equities, right? Large caps. People already buy and sell these things all day long. There's going to be demand to buy and sell them on chain as well. And then I think as you go kind of down the liquidity spectrum, it reflects a lack of interest, right? Even in terms of like private credit, for example, I think has been historically very difficult to tokenize and find actual product market fit.
So on that side, I think, yes, you are right. There is a big issue with everyone that has illiquid assets being like, oh, this might be an easy way for me to get rid of this stuff. But also it provides an opportunity, particularly on the private credit side, where you can actually make the underlying of a fund also be a tokenized asset, and then move the actual distributions fully on chain. A good example might just be US mortgage-backed securities. If Fannie Mae and essentially decided, okay, let me go ahead and just start tokenizing my entire database, 1/3 of the US housing market, all of a sudden now you can directly track cash flows into different properties, mortgages, packaging them up into mortgage-backed securities, all the way down into the actual tokenized side. And now you've created massive amounts of liquidity and understanding and transparency into an asset that's already fairly transparent, et cetera. But that's just one very good example. And so I think tokenization also creates an opportunity for high quality illiquid assets to become more transparent and liquid if you're able to tokenize the underlying within it, as well as the cash distributions as well. That stuff will still take some time, but I think there are asset managers out there that are actually actively looking into tokenizing not just a single fund or an ETF, but the full underlying and the actual supply chain of the distributions of the cash flows as well. So that's pretty interesting. I think also another interesting aspect is just data provenance. If you start, like, obviously everyone, we've seen real estate and it has not gone that well because we've been trying to put, legal ownership of real estate. But I was just actually talking to one of the largest banks in Asia in their commercial real estate department. And one thing they like to do is they want to, they've actually been able to figure out how to make a lot of their underwriting be much more liquid, because they've got this blockchain platform that essentially is able to get them significantly cheaper evaluations on a monthly basis of different properties. That's 1/10 the price. So now they actually can do LTV that is constantly changing, and they're able to get much better rates on the different loans that they're giving out for large commercial real estate projects.
Yeah, I think that makes a lot of sense. I think on Plume, what we're seeing is, when we first started the chain, a lot of money was flowing into more top of funnel assets. I think, kind of like what you both touched upon, like more liquid T-bills. Most recently we just deployed Apollo's private credit fund, and Grove is, depositing $50 million into those assets. But it's very interesting now that, our chain TVL is structured as, 70% retail and 30% LP. Before, when we started, it was more skewed towards the LP side. And what we're seeing is actually a lot of users wanting to, invest into certain RWA assets if they're structured the right way. So what I mean by that is, for example, on Plume right now, we have a product called Nest.credit. And one of our vaults is, 50% of a basis trade, 30% treasuries, 20% private credit. And that way we can kind of mix and match these different assets to increase the yield while decreasing the risk, and even throw specific incentives towards these different vaults. And what we're seeing is users are actually, depositing money to these different vaults, collateralizing it on Morpho on Plume, and then borrowing more stables against it and looping it as you would in DeFi. And I think, by being able to have these types of assets that are more familiar to users after you do tons of educational resources around it, I think you can really unlock that next level for real world assets on the more retail side of things, which is, our aim on our ecosystem.
Not to go like too into the weeds, but like, who is the person that wants to deposit to Morpho instead of the vault?
Oh, it's basically someone would deposit into the Nest vault, take the LP token out, and then deposit into Morpho as a collateral asset.
Yeah, and they have to borrow USDC
Then they
against
can
your...
borrow like at like 60-70% LTV. So the vaults are curated by different curators that we work.
So if you want to leverage the already leveraged vault.
Sorry, what?
So if you want to leverage the already looped vault,
in a sense,
or it's like in some cases,
it's
vaults are not
in a
looped.
sense it's kind of like leverage looping,
Okay.
but it's structured by curators that are like RE7, MEV. Those two vaults are the most prominent on Morpho and Plume, and that way we can actually do it in a more risk-free sense.
Oh, got it. So you're diversify, like you deposit USDC into Morpho, and then you get some of it's borrowed to buy.
It's more so like you're depositing USDC or PUSD into these different Nest vaults, and then you're getting the LP token that's accruing rewards from there, and then you can collateralize that on Morpho, but specifically into like an RE7 or MEV vault, and then you can borrow more stables against that.
Yeah, I guess I'm wondering who would deposit stables into the MEV or RE7 vault instead of just depositing into the Nest vault.
Oh no, they start on the Nest vault and then they go to the MEV vault after with the LP. So the collateral asset going to the MEV vault is actually like the Nest collateral.
Right. But like they're borrowing that USDC from someone.
Are you saying who's the lender?
Yeah, who's the lender?
I see. It's
underwriting all this?
Yeah, like why would you if you're willing to underwrite the credit risk on the Nest vault, why would you accept a lower rate of return than you would just get by depositing into the Nest vault?
It's seeded by a lot of our different LPs in the initial days. Like that's how we started off the chain. And like a lot of the seeding was actually done through more like crypto native manners, like through incentives and those types of deals. But once the flywheel kind of kicks off, it actually accelerates pretty quickly if you can accelerate it the right way.
Yeah. Well, fascinating conversation. I'm sure we can do a follow-up actually off stage, but I do want to squeeze two more questions in. Actually, one is if we zoom out in 5 to 10 years where, the future has come, everything's tokenized, what actually don't you think will live on chain when it comes in the RWA context? Like what type of asset class is just not suitable for tokenization? And what are the other side of the world where you see in the future, like T-bill, I will suppose like everything's tokenized on chain, and what else? So what are the kind of the two sides on chain versus off chain in 5 to 10 years?
I think still legal ownership structures is probably still going to be very hard to get on chain. I think anywhere where you have people needing to argue about something is just not going to work that well, or like claiming through different jurisdictions, etc. A lot of other things I definitely see starting to move on chain very rapidly. I think bank deposits are starting to move on chain. That's going to create massive amounts of liquidity for RWAs as you have banks essentially starting to move in. It's like small, medium, regional banks starting to play in the same ground as like the much larger banks, that because tokenized deposits allows them to do that.
Yeah, I mean, I think I think one of the products that we've seen do incredibly well that Ondo doesn't. I mean, you could buy. One of the products I think we've done that's done really well is gold, right? I think we continue to see like very strong demand for it. It's like, obviously it's mooning, so that helps, but it's not the easiest thing to like go out and buy physical gold, and you pay like quite a bit of spread when you go do that at like a retail facing, gold shop, right? And you can buy the ETFs, but like if you live in a jurisdiction where that's not easy, or like you tend to keep your money on chain, like I do, really like Tether Gold and Paxos Gold have been like your best options. Now with Ondo, you can do like tokenized gold ETFs, which is kind of nice and tends to charge lower fees, which is nice and has better liquidity. I think we're just going to see that kind of like global, highly commoditized asset class. Like part of the reason T-bills works is like everybody knows what they're getting, right? Same thing with gold, same thing with like US equities. I think that stuff like makes by far the most sense for like the immediate term tokenization. And then I think the more complex stuff will wind up ultimately being some mix of complex TradFi back office operations that enable, brokerages and whoever to offer those products directly on chain themselves.
Yeah, I think Matt and Omar have a point. I think at least on Plume, real estate actually hasn't been a super liquid asset, so you don't really see as much demand for those types of assets right now. I think typically, users want closer to double digits APYs, and then duration wise they kind of want their money back between like 1 to 6 months maybe at most. And for certain types of I guess real estate that different real estate projects that we've spoken with, it's a lot longer. So I think that asset class could maybe be more liquid in the future that to really have real demand.
Just one thing on the real estate one, say there's a distinction between ownership and the cash flow rights, etc. I think the cash flow side of things will definitely be tokenized, and that will make a lot of sense. The ownership stuff that we've been trying to do for the last couple cycles in real estate, I think still probably doesn't really, not going to come on chain that well.
I'm curious how, last question being, what's your view on latent market? So for example, tokenized uranium, we back that one. So kind of to your earlier comment of, okay, this needs to be traded today to show there's demand. And then you can tokenize it on chain. So there's liquidity, there's demand for it. But then could there be an argument being made that there are a lot of latent markets because of the capital structure, because of the archaic financial rail that is not being traded, that could actually unlock by bring on chain?
Yeah, that 100% is the case for a lot of assets, right? I think the problem though is that a lot of times people build things assuming there's a latent market issue, and they haven't really done the deep research needed to vet that hypothesis. Like in the airline industry, this is a thing where like some airlines will just put routes like between cities where like there's already proven demand. Some airlines will put nonstop routes and experiment a little bit more when they see that like a lot of itineraries have one stop in the middle. I think that's kind of like we need more data driven analysis to like truly understand, right? I think with uranium, it's like really easy fundamental thesis, right? Like power needs are going to grow because of AI. The cleanest, like most like reliable form of power in a lot of cases is going to be nuclear. There's like it's really difficult to invest in it in any other way. So of course there's like latent demand there.
There needs to be basically a macro catalyst. And speaking of that, in the ending note, I'd love to see in your eyes, what are the next catalysts for RWA as a sector?
I think leverage. I think leverage still has by far the strongest product market fit of anything across all of crypto, outside of maybe stablecoins. And you could argue stablecoins have product market fit in a lot of cases because they're the settlement asset for levered perps, right? I think we're going to see like really fast proliferation of levered RWAs, whether it's like through sort of more DeFi looping based structures, or I think we're going to start to see perps on a lot of this stuff. In the very, very near future. We've seen some attempts at it. We've seen like Ostium, their liquidity model, it doesn't quite work. We're going to start to see like like every market maker, every perps builder I've talked to, the number one thing on their minds is RWA perps right now.
That's alpha.
Earn programs and tokenized deposits. Literally any sort of balance sheet that's just sitting there will start to become tokenized, and it will start having velocity. And that's going to create a lot of demand for risk, leverage, and moving further out the yield curve than just sitting in cash.
Yeah, I think like the intersection of RWAs and DeFi. I mean, we're already seeing it happen with different types of institutional products coming on. Like, A-Cred wants, Christina wants to be able to loop this asset on Plume. A bunch of other folks that we're speaking with, they also want to tap into the DeFi side of things. So kind of like what Matt and Omar were saying, it's, I think that's probably where we're trending for sure.
Awesome. With that, well, thank you for all of your time.